All participants, please stand by. Your conference is now ready to begin. Good day, ladies and gentlemen, and welcome to the OPG Investor Call. I would now like to turn the meeting over to Mr. Neil Kelly, Director of Media Relations and Issues Management. Please go ahead, Mr. Kelly.
Thank you, and welcome to our investor call to discuss Ontario Power Generation's second quarter financial and operational results. My name is Neil Kelly. I'm joined today by OPG Chief Executive Officer and President Ken Hartwick and OPG Chief Financial Officer John Mowdy. Mr. Hartwick and Mr. Mowdy will present a slide deck that you will be able to follow on your computer if you are logged on to this WebEx. Once the presentation is finished, we will be open to questions from investors. I will facilitate the question and answer session, and the operator will provide instructions to investors with questions. Just a reminder, this is an investor call. Media and others are welcome to listen, but only investors will be able to ask questions. Before I turn things over to Ken, I want to bring to your attention slide 3, disclaimers for a caution on forward-looking statements and the use of non-GAAP financial measures in this presentation. Note that certain material factors or assumptions are applied in making forward-looking statements, and actual results may differ materially from what is stated. This slide also indicates where to find more information on topics and what factors could cause actual results to differ materially from those stated. You'll also see a slide for today's agenda. I will now turn the call over to Mr. Hartwick.
Thank you, Neil. Good morning, and thank you all for joining this call. We're pleased to have this opportunity to update you and to share our results for the first half of the year, and to discuss how we are continuing to achieve our strategic goals. In the first 6 months, we have continued to make significant strides financially and operationally, while working to ensure we remain Ontario's largest low-cost clean power generator. This has come off the back of strong generation performance and outage execution across our nuclear fleet, which continues to contribute reliably to the grid. Our regulated hydroelectric generation also experienced an increase in the second quarter due to higher water flows across most of Ontario. The high water levels this past spring represented significant challenges to our operations and communities near those river systems. Our renewable generation team worked closely with municipalities and local authorities to mitigate the impacts to communities while managing the water in a safe and coordinated manner. On the Darlington refurbishment project, we made major advances in the second quarter on Unit 2. Which is the first of our 4 reactors to be refurbished. We successfully completed the installation of fuel channels as well as upper and middle feeders. 33 of 58 major plant systems have been returned to service. Unit 2 is currently undergoing lower feeder installation, where we have identified some challenges in achieving the planned installation rate for this series. Given these challenges, we have revised our schedule for Unit 2's return to service. We now expect the unit to return to service in June 2020 rather than February 2020 as originally planned and within our Unit 2 budget. This will ensure that commissioning is completed safely and to the highest industry standards. We have taken several mitigating steps to ensure the remaining work on Unit 2 is executed as planned. This includes resequencing work activities, expanding training, deploying new tooling, and injecting additional OP project management leadership. The lessons learned and actions taken are also being carefully applied to maintain strong cost control, improve schedule performance, and to reduce risk for all future units. The revised schedule on Unit 2 will not have an impact on the overall project schedule or budget. Overall, the project continues to track on schedule and to our $12.8 billion budget. Preparation is also continuing for refurbishment of the next unit, Unit 3, which is expected to begin in Q1 of 2020. This critically important project for OPG and all of Ontario will extend the operating life of the Darlington station by 30 years and I am confident we will continue to execute successfully. The past few months have also seen us grow our business for the future through acquisitions. We recently entered into purchase agreements to acquire a portfolio of combined cycle natural gas-fired plants in Ontario. These acquisitions will add more than 2,000 megawatts to OPG's in-service generating capacity. Natural gas plays a critical role in ensuring the reliability of our electricity system by generating power during peak periods. Its ability to respond to changes in demand helps backstop intermittent sources of power like wind and solar. Expanding our natural gas portfolio provides an ability to grow our financial performance, which supports the continued strong financial performance by the company to our shareholder. Also in Q2, we entered in an agreement to acquire Cube Hydro, an operator of 19 small and medium-sized hydro facilities in the U.S., representing a total of 385 megawatts of capacity. This acquisition will provide additional scale to our existing U.S. hydroelectric platform and generate more operational synergies. These assets are in areas that OPG has largely operated in and are consistent with our core strengths. We will now take a pause from acquisition activities and focus on integrating these assets. As Ontario's only publicly owned utility electricity generator, our focus remains on bettering the province economically and environmentally. We believe these acquisitions will improve the company, help facilitate a sustainable, low-carbon future, and provide reliable, low-cost power for future generations. All in all, I'm pleased with our performance this past quarter and the quality of recent acquisitions. We remain committed to operating safely and reliably while delivering the value to our shareholder and low-cost power to all. Now I'd like to turn things over to John Maudy, OPG's Chief Financial Officer, to go over the past quarter's results in more detail.
Thanks, Ken. For the 3 months ended June 30th, 2019, OPG reported net income attributable to the shareholder of $351 million, compared to $121 million in 2018. This was a result of fewer planned outage days at Darlington and Pickering, resulting in more nuclear generation, higher revenue, and lower operating and maintenance-related expenses. This was as expected and in line with our cyclical maintenance schedule. Overall, for the 6 months ended June 30th, our net income has tracked positively compared to 2018 after taking into account the gain on sale of the former Lakeview Generating Station site and associated refundable tax credit. Looking at our electricity generation, production from our regulated nuclear and hydroelectric stations saw improvements over the past quarter and the first 6 months of 2019. Our hydroelectric assets continue to operate with stability, and production from this segment saw an increase this year due to higher water flows across much of the province. On the regulated nuclear side, production has increased compared to the same period last year. As previously mentioned, this was due to increased production as a result of fewer planned outage days at our nuclear stations. In the contracted and other generation segment, we saw a positive impact on production from our acquisition of Eagle Creek's hydroelectric facilities in the U.S., but we experienced an overall decrease in segment production due to lower demand for generation from our contracted facilities in Q2. Overall, our core generating business remains strong and growing. Our enterprise total generation cost, or TGC, is the cost to generate 1 megawatt hour of electricity in Ontario. Both in Q2 and year-to-date, our TGC decreased significantly compared to the same period in 2018. Higher generation from our nuclear and hydroelectric facilities, as well as lower nuclear O&M expenses, have all factored into the decrease in our total generating costs in 2019. On the Darlington refurbishment, we continue to make steady progress. This past quarter, we completed the fuel channel assemblies and the upper and middle feeder pipe installation series. The project is currently executing the lower feeder installation series. As Ken mentioned, we have experienced some challenges in achieving the planned installation rates for the lower feeders on Unit 2. This will extend the time frame of this series to the fourth quarter of 2019. Under the revised schedule, Unit 2 is now expected to return to service by June of 2020 rather than February 2020. This revised schedule will not have an impact on the overall project schedule or budget. We continue to expect the overall refurbishment project to be executed on time and within the $12.8 billion budget. Preparation is ongoing for the refurbishment of Unit 3. The targeted start date for execution on Unit 3 refurbishment is set for Q1 2020. As Ken alluded to earlier, OPG is continuing to build its business with a balanced growth strategy. That means we are investing in our core assets and strengths by allocating resources to our operations in both the regulated and unregulated business. These investments will allow us to maintain our scale of operations, moderate customer prices, and provide positive returns for our shareholder. Our balanced growth strategy also includes strategic acquisitions to maintain leadership in the industry and help facilitate a low-carbon future. I will go over some of our most recent acquisitions now. We recently announced that we have entered into a purchase agreement to acquire a portfolio of combined cycle natural gas-fired plants in Ontario. OPG will be acquiring full ownership of the Napanee Generating Station and Halton Hills Generating Station, as well as the remaining 50% ownership in the Portlands Energy Centre, located in Toronto, and the Brighton Beach Generating Station in Windsor. These acquisitions, when approved, will add more than 2,000 megawatts to OPG's in-service generating capacity at a total acquisition value of over $3 billion. These facilities are under energy supply agreements with the independent electricity system operator, with a weighted average remaining contract term of approximately 17 years. The acquisitions are subject to a number of closing conditions, including receipt of regulatory approval and commencement of commercial operations at the Napanee Generating Station. The Brighton Beach acquisition is expected to close in the third quarter, and the balance of the assets are expected to close around the turn of the year. As Ken mentioned, these acquisitions will expand OPG's generation portfolio while helping to ensure the reliability of Ontario's electricity system for the future. This past quarter, OPG also entered into a purchase agreement to acquire Cube Hydro for approximately $1.12 billion US, inclusive of debt assumed. Cube operates 19 small and medium-sized hydroelectric facilities across the northeastern and southeastern U.S., with a total in-service generating capacity of 385 megawatts. The deal will be financed primarily through OPG's corporate public debt program or other available credit facilities. We expect the acquisition to close before the end of the year. This exciting acquisition will provide additional scale to our existing U.S. hydroelectric platform, which already includes assets from the recently acquired Eagle Creek Renewable Energy. I would also like to highlight OPG's commitment to operating in a sustainable manner that takes into consideration environmental, social, and economic concerns. We continue to produce clean, reliable, and cost-effective power while protecting the environment and positively impacting our communities. OPG has maintained an ISO 14001 certified environmental management system since 1999. We are consistently recognized by international groups like Wildlife Habitat Council for processes that manage our environmental impact and improve our natural surroundings. We've worked with partners to plant more than 7 million native trees and shrubs on approximately 2,850 hectares of land across Ontario. And we helped stock more than 336,000 one-year-old salmon since 2011 as lead sponsor of the Ontario Federation of Anglers and Hunters Lake Ontario Atlantic Salmon Restoration Program. And we are proud to be one of Canada's best 50 corporate citizens for the 6th year in a row. We're committed to remaining a model corporate citizen for years to come. Looking at our overall corporate profile, OPG continues to maintain a strong balance sheet backed by $52.6 billion of assets. Following the announcement of our most recent acquisitions, our long-term credit ratings from S&P Global at BBB+ and DBRS at A low continue to demonstrate the strong creditworthiness of the company. We are backed by stable operations through our regulated fleet and supplemented through long-term contracts for much of our non-regulated facilities. OPG continues to monitor and manage our credit ratings profile and metrics and intends to maintain a strong investment-grade credit rating. Both ratings reflect the announced acquisitions, which are expected to be principally debt-funded. In terms of our capital structure, the company continues to diversify its financing base through a mix of public debt and funding from the Ontario Electricity Financial Corporation. The company also continues to be positioned well in terms of liquidity, with a long maturity timeframe on its debt and manageable near-term debt refinancing needs. The acquisitions will be financed over the long term through the debt capital markets. However, a significant portion of the financing need as part of closing on these deals can be accomplished through short-term programs, including existing or expanded commercial paper and credit facilities and term loans until long-term debt is issued. Utilizing shorter-term funding allows us to be responsive to market conditions and ensure an orderly access to longer-term debt markets. As indicated, a large majority of OPG's term debt has a long maturity profile, and the use of shorter-term options helps provide more of a balance to OPG's financing needs. We believe all of our recent investments and acquisitions will ultimately benefit the shareholder and people of Ontario, providing great value for decades to come. I'd now like to turn it back over to Ken to leave you with some closing thoughts.
Thanks, John. In closing, I'd like to reiterate our financial strength as a company. As our past quarter has shown, we continue to execute on our core strengths of producing clean, low-cost, reliable power for Ontario. And we are now growing our company and promising to deliver even more value through several key strategic acquisitions. With the announced acquisitions, OPG is looking to integrate the assets to deliver value to our shareholder. In our regulated nuclear business, we have benefited from regulatory price certainty and fewer planned outage days. We also continue to execute the Darlington Unit 2 refurbishment safely to the highest standard of quality, with the overall Darlington refurbishment project remaining on schedule and on budget. In our regulated hydroelectric and contracted and other generation segments, we continue to generate stable earnings and cash flow, and we expect to see the same level of performance from operations for the rest of the year. We expect cash flow from operating activities will continue to improve throughout 2019 as collection continues from our new regulated prices set by the Ontario Energy Board and recovery of deferral in various accounts. Our nuclear segregated funds, which will fund future decommissioning and waste management at nuclear stations, remain fully funded. This provides further liquidity to the company. Looking to the rest of 2019, we expect to continue our strong performance and execute on all our major projects, including the Darlington refurbishment project. I am pleased with the progress we have made on our growth efforts and on our operational and safety excellence. We continue to be committed to delivering value to Ontario while generating safe, reliable, low-cost power to the province. And I want to thank all of our employees for their unwavering commitment to the safety across OPG. I'll now turn the call back to Neil Kelly.
Thanks, Ken. We will now begin the question and answer session, and I will ask the operator to run through the process for investors to ask their questions. Just a reminder, this is an investor call, and therefore only investors are able to ask questions. I'll remind investors to follow the operator instructions, and please identify yourself before asking a question. Operator?
Thank you. We will now take questions from the telephone lines. If you have a question and you are using a speakerphone, please lift your handset before making your selection. If you have a question, please press star 1 on the telephone keypad. At any time you wish, you can also cancel the question by pressing the pound sign. So please press star 1 at this time if you have a question. There will be a brief pause while the participants register. We thank you for your patience. Once again, please press star 1 on your telephone keypad if you have a question. We have a first question from Stephen Defoy from Asset Management 1832. Please go ahead. Your line is open.
Good morning, and thanks for having the call. The MD&A describes that surplus baseload conditions in the quarter resulted in higher forgone hydro generation at OPG. Could you just describe what led to the surplus baseload conditions going up, and also remind us how that impacts both gross margin, I believe that's all in the quarter, but also how the variance account sort of recovers that amount and when that would flow through the cash flow statement? Thank you.
It's John Mody here, Chief Financial Officer. Our surplus baseload conditions primarily are from economic market conditions within the province in terms of clearing prices for generation. So conditions during the quarter were also exacerbated a bit with the volume of water flow, so that the amount of generation going through our stations was higher. So when those market conditions and clearing prices are low enough, we are instructed through the independent electricity system operator to not generate during those periods. We are compensated through regulatory variance accounts that we have authorized with the Ontario Energy Board, where basically our gross margin is protected. And when we are told to not generate during those periods, we basically make that equivalent up and book those amounts into that variance accounts, which are then subsequently cleared through a process in the future with the Ontario Energy Board. So there's, other than a small timing issue of collection, the cash flow would be protected. And then when we apply it to the Ontario Energy Board, next time we would clear balances as of a close of a certain fiscal year, and it would be recovered through rate riders on top of our base electricity rates at points in the future.
Okay, so that it sounds like the actual recovery would probably be in a later year and not later in 2019?
Correct, yeah. The next time that we would go in front of the Ontario Energy Board, we would tend to clear balances in those variance accounts, typically at the end of a certain fiscal year, so there may be potentially a year or two lag between booking amounts into those variance accounts and their ultimate collection.
That's great, thank you.
Thank you. Once again, please press star 1 on your telephone keypad if you have a question. Please press star 1. Thank you. The next question is from Bob Maxwell from Sun Life. Please go ahead. Your line is open, sir.
Hello. Thanks for taking my question. Just wanted to see if you could provide a little more color on the negative outlook by S&P and maybe any discussions you've had with them about that.
Sure, it's John Mody again. The discussions we've had with S&P, in addition to our regular annual update, we briefed them fully for each of the acquisitions that we have made in the past several months. Given the fact that we're largely debt financing those acquisitions, they were interested in viewing the cash flow prospects from that. Each of those acquisitions, or the acquisitions that we've engaged in, are in unregulated or non-regulated parts of the operations, but in large part they are backed. For example, the gas plants in Ontario are backed by long-term secure contracts coming forward. The fact that we've taken on the additional sort of debt into our forecast, we were not surprised that there was perhaps a change to a negative outlook that just reduces the runway going forward in terms of cash flow. So I think what S&P would like to see going forward is consistency in how we integrate those acquisitions and ensure that we continue with the core of our operations, which are still remain regulated, to ensure that we're able to deliver on and secure cash flows from those operations going forward.
Okay, thank you. Could you maybe just also talk a little bit more about going forward, how you would see regulated assets versus non-regulated assets in your mix, and I guess maybe just whether you have any sort of targets for for the proportion of the business that would be non-regulated?
Right. We still have a significantly large portion of our cash flows is still from regulated assets, and even the unregulated ones we have, whether it was our existing hydroelectric energy supply agreements for some existing assets, the assets we're acquiring, the gas-fired ones in Ontario, they are all backed by very sort of long-term, very stable cash flow coming from those contracts. So even though the percentage has been now becoming a little larger on the unregulated side, those unregulated assets largely have very stable cash flows associated with them.
Yeah, and I just add to that, if you go to our mix, if you look at our Darlington refurbishment is a $12.8 billion investment into the regulated side of our business, as is just our core CapEx program. So we would view the relative mix of this being, again, small in the scale of what we invest on an annual basis, and in Darlington's case, over the course of the next 6 or 7 years.
Great, thank you.
Thank you. The next question is from Katish Gurel from CIBC Asset Management. Please go ahead. Your line is open.
Thank you. Yeah, my question is just a clarification question. Are you planning to finance, when you say 100% debt financing of the acquisitions, are they going to be on a recourse basis as part of, just the general OPG program, or more like what you guys did on the Matagami projects?
No, our intent is to do debt financing from our balance sheet fully, not specific to not project financing like we have in the past on, you mentioned the Lower Matagami investment. So this would be through our medium-term note program of the back of the balance sheet as a whole.
Okay, so you will get a benefit of all the assets.
Correct, yes.
Okay, thank you.
Thank you. There are no further questions registered at this time. I will return the meeting back to Mr. Kelly.
Okay, thank you. As always, investors with follow-up questions can call OPG's Investor and Media Relations line at 416-592-4008 or 1-877-592-4008. Thank you for participating, and have a wonderful day.
Thank you. The conference has now ended. Please disconnect your lines at this time, and we thank you for your participation.